How does your city government determine how much property tax you have to pay? There are 4 steps. Step 1. The city determines how much money it wants to spend in the next year. This is what they're doing when they're setting the budget. Step 2. The local government's assessment staff assesses the total value of all of the taxable property in the municipality. Step 3. To set the property tax rate, the city takes the total amount of money that it wants to spend and divides that by the total assessed value of all of the taxable property. Sometimes this is called the mill rate. Some municipalities report this as a percentage. For instance, you might be asked to pay 0.6% of your property's assessed value in property tax one year. Other times they express it in terms of mills. If the mill rate is 6, then this means that the city wants you to pay $6 for every $1,000 in assessed value, or 0.6%. Step 4. For your specific property tax bill, the city takes your assessed property value and multiplies that by the property tax rate. Pretty simple. There are 2 things you should notice about this system. Thing number 1. The mill rate itself is basically meaningless. For example, if a municipality wanted to charge the same amount of property tax in year 1 and year 2, but the property value in that city doubled in year 2, what they would do is actually reduce the mill rate, or the property tax rate, by half. Would you really say in that case that you had a property tax cut? Probably not. This makes comparing mill rates or property tax rates between different cities, or even for the same city in 2 different years, reasonably difficult. Thing number 2. Property tax more or less allows a city to collect all of the revenue that it set out to collect. Why is this? When your municipality sends you a property tax bill, it's based on an assessment that's already taken place, on a property tax rate that's already been set. So basically, you get a bill that you have to pay. But for other levels of government, the federal or provincial governments for instance, that use an income tax, the situation is quite different. What these levels of government do is set the income tax rate for the next year, and then tax your income at that rate. The big difference is, of course, that they don't really know what people's incomes are going to be over the next year. They can certainly make educated guesses, but they don't know for sure. That means in a boom year, incomes could be higher than expected, and government revenues could be very high. But in a bust year, incomes could be much lower than expected. For municipalities, this is very rarely the case. Cities can collect all of the revenue that they set out to collect, except for properties that somehow become untaxable. For instance, properties that are destroyed in a fire or something similar. Because cities tax you on an assessment that's already taken place, they're pretty much able to collect all of the money that they want to. And that's how your local government figures out how much property tax you have to pay.